Okay, so if you're looking at the US economy right now, it's kind of telling two completely different stories. On one hand, you've got this story of booming markets, record highs, a real party. But then, on the other hand, there are these whispers, no, more like loud warnings about serious risks hiding just beneath the surface. So, what's the real story here? Which one is true? Well, that's exactly what we're going to break down.
And that really is the million-dollar question, isn't it? Why in the world is the stock market rallying? I mean, hitting new highs when some of the smartest people in the room, these major global organizations, are flashing these huge warning signs. It just doesn't seem to add up. It feels like a total contradiction, right? But believe it or not, there are some pretty solid reasons for both sides of this argument.
And this really lays out that divide perfectly. You've got the bright side, major stock indexes are up, tech stocks are roaring back to life, and there's a lot of hope that the Fed might actually start cutting interest rates. But then you look at the other column, the warning signs, and it's a different story. You hear talk of a potential AI bubble, you see official forecasts for slowing economic growth, and you can't ignore the global trade tensions that are bubbling up. So let's start with the good news, right? Let's look at the case for all this optimism.
All right, so first up, let's dive into that glass half full view. This is the perspective that's been pouring fuel on this recent market rally.
So the big headline here, the one everyone's talking about, is that the major US stock indexes, the S&P 500 and the Nasdaq, they've been on a tear, just climbing and climbing. And what's the engine behind all this? Well, it's a massive rebound in tech stocks, and more specifically, the ones all wrapped up in the world of artificial intelligence. I mean, look no further than NVIDIA. This company is right at the heart of the whole AI revolution. A recent 3% jump, that's a perfect snapshot of just how much confidence and cash is pouring into this space right now.
And hey, this isn't just a one-company show. You've got Dell Technologies posting a 5% gain. This shows you that the enthusiasm is spreading across other key players, especially in the hardware space. They're all riding this massive AI wave.
Now, you might be thinking, is this just a bunch of hype? But it's not just coming from individual traders. We're talking about major institutions like Bank of America. They're saying this trend has real staying power. Their research basically concludes that this AI-driven boom has legs. In other words, they think this is a huge, long-term shift, not just some flash in the pan. So if you boil it all down, the optimism really stands on four main pillars. First, companies are investing a ton of money in technology. Second, there are big bets that the Fed is going to cut interest rates soon. Third, people are expecting solid GDP growth down the line. And finally, there's just this powerful underlying belief in the massive long-term potential of AI. But, like I said, that's only one side of the coin.
Okay, so now it's time to flip that coin over and look at the glass half empty side of things. Because for all that incredible optimism, there are some very real risks lurking. Probably the biggest fear out there is something that the OECD, that's the Organization for Economic Cooperation and Development, is calling a potential AI bubble. The idea is pretty simple, really. What if all the excitement has just gotten way ahead of the actual reality? If everyone gets too optimistic and pushes stock prices to crazy levels, well, any little change in mood could trigger a really sharp and, frankly, painful market correction.
And look, this isn't just a vague feeling. This concern is actually backed up by some broader economic data. That very same organization, the OECD, is projecting that U.S. economic growth is set to slow down. We're talking from about 2% this year to just 1.7% by 2026. And let me tell you, a stock market that's rallying while the underlying economy is slowing down, that is a classic warning sign. Right. And we can't forget that the U.S. economy doesn't just exist in a bubble. There are all these global pressures mounting up. We're talking international trade tensions, new tariffs getting thrown around, and the simple fact that it's getting more expensive to borrow money all over the world. Literally any one of these things could send a shockwave right through the U.S. market and stop this rally dead in its tracks.
So there you have it, a booming market on one side and a dashboard full of flashing red lights on the other. The big question is, how on earth do you make sense of this? How do you navigate all this uncertainty?
Well, I think the best way to describe where we are right now is a phrase that comes straight from the source material. We're in a cautious opportunity zone. What does that mean? It means there's absolutely real potential to make gains, especially in tech. But, and this is a big but, the level of risk is way, way higher than normal. This is the time for being strategic and careful, not for blind optimism. So what should you be watching? There are 4 key signals to keep a close eye on. Number 1, inflation data. That's what's going to tell us what the Fed will do with interest rates. Number 2, AI valuations. Are they getting too frothy? We need to watch for any changes in sentiment there. 3, global developments. You know those external shocks we talked about can ripple into U.S. markets in a heartbeat. And finally, number 4, corporate earnings. This is the ultimate reality check. Are these high-flying companies actually delivering the profits to back up their stock prices? So how do you actually play this? Well, it really all comes down to your personal appetite for risk. If you're thinking long-term growth, you might focus on those big trends like AI, clean energy, and infrastructure. But if you're looking for a lower risk path, you'd probably lean more towards safer bets, things like dividend stocks or diversified ETFs that are built to better weather any potential storms on the horizon.
And all of this brings us to one final, really thought-provoking question. In a market that's defined by this exact tension, this pull between incredible opportunity on one side and really significant risk on the other, what's the bigger gamble? Is it jumping in and taking action, trying to ride this wave? Or is it sitting on the sidelines, playing it safe out of caution? Honestly, that's the dilemma that's sitting right at the very heart of today's economy.